What's happening, everybody? It's Huddy. I'm here with Dawn Michelle Crow of Keller Williams Realty. We're talking about some newsworthy type stuff, I think, or something that's been on people's minds a lot, especially with the way the market and inflation has been going. Dawn, what do you think? What do you know?
Well, what I know is that people are looking at the Fed interest rate, and it just recently went up, right?
Yes, it did. The Fed came out and increased the Fed funds rate by 3/4 of a point again.
And so how does that affect my mortgage rate?
Well, oddly enough, it doesn't. It's not the mortgage interest rate. The Fed funds rate is the rate in which the federal government lends money to banks overnight. That's what it is.
And so what does that do?
So what that does is that's going to affect your short-term rates. So when we're talking about those types of things, I want you to think about your credit cards. Maybe you have a line of credit attached to your checking account. We're talking about student loans. We're talking about home equity products. So if you're looking at getting a home equity loan or a home equity line of credit.
So really it's the Fed interest rate, when they raise it or lower it, it affects that short-term money, not long-term money, which is like mortgage rates.
That's correct. It's short-term money, so think prime rate. Prime rate is not the mortgage interest rate. Long-term money, it can bleed into us because the mortgage interest rate, there's a lot of different things that can factor into that, but primarily think the bond, the treasury, things that are long-term notes. That's what the mortgage interest rate is going to be primarily based off of.
So the Fed raised the interest rate, and what are we seeing with mortgages though?
That's the interesting thing. So we've heard that the Fed increased the Fed fund rate by 3/4 of a point, but the latest news that has come out is inflation numbers, and they're not nearly where they were predicted to be. So last week we saw an unbelievable price decrease in mortgage interest rates, meaning they got better considerably just last Friday.
That's fantastic for the buyers that are out there right now.
It is. If you're not talking to your lender, if you're locked, you want to be talking about renegotiating because that is how much they improved last week.
That's fantastic. So when people are out there looking at interest rates and listening to the news, you want to not listen to what the Fed rate does, because that's really not what is driving the mortgage interest rate.
That's correct. Your best thing to do is talk to your lender. If you're thinking about buying a house, or even if you're still considering maybe refinancing, talking to a lender and learning what your situation is and where the rate could fall for your particular situation.
Right, and it changes consistently.
That's right. We have new rates that come out every single morning. Sometimes they can change once a day, twice a day, but they have changed sometimes 5 or 6 times a day. We're an active market. We're not just meeting, like the Feds, they meet like once every 6 weeks and they adjust the Fed funds rate. We're in the active market, so the mortgage interest rate changes several times a day.
Yeah, interest rates are a complex topic, and we are definitely open to talking to you if you want to learn more about that. But if you're looking at purchasing that home, don't look at predictions, don't look at the Fed fund rate, talk to your lender and get the real information. The internet is a fun, entertaining place to be, but it's not the real facts and the reality of a situation for you.
That's right. So if you have any questions, feel free to drop a comment, shoot a message. We appreciate you checking out this video. We'll see you at the next one.